Hey, hey, hey! It's the first ever real estate marathon. I'm your host, Jas Takhar. Guys, we got someone that's coming on right now that not only is a great friend of REC, but he is the go-to mortgage advisor for all things news, the BNNs, the Globe and Mails. This gentleman has funded over $1 billion in mortgages. What? 2.5 billion. We got to update your bio. It's my man. It's my boy, my friend. I get to call him a friend, Mr. Calum Ross.
What's up, brother?
How you doing?
Fantastic, thank you.
Thanks for being part of the marathon.
Thank you for having me. One of the things I realized is that I don't think I've seen Phil sober before without makeup on, because I've always wanted too much studios. You know what? I'm sort of traumatized because part of me wants to have makeup now because I see what a competitive advantage it is. When I look at all these people on the screens.
We will definitely have that set up for the second.
How does
second
Laura
marathon.
get airbrushed and I don't get airbrushed? That's just so not fair.
Well,
It's
Laura
like
wakes up like that. I think she tells us she just wakes up in the morning like that. Calum.
Yes, sir.
Thank you so much for being part of the first ever real estate marathon. You're part of history. I sent you a text message. I've been saying this to all the speakers. I'm so blessed and so grateful because I sent out one message to everyone, including yourself, and you're like, Jas, just whatever time, whenever, you let me know, I'm there. So thank you for that, brother.
Oh, listen, it's amazing. Well, you look at the people we've got here speaking today, right? I mean, frick, I would have paid just to hang out here.
Thank you, brother. Thank you.
All these people, I sit back and look at all the people we're blessed to have on our network, right? I mean, my first 5 years in mortgages, Phil Silver wouldn't even say hi to
me. Things have changed. Things have changed.
Yeah.
$2.5 billion of mortgages funded. You guys, if you're new to us, you haven't heard me say it, but I say it a lot when it comes to mortgages and mortgage advisors. In my opinion, I like to think I'm the most important person in the role when you're investing and purchasing, but it really is the mortgage advisors, because what they do is they're going to be able to get us the money to figure out how much we can get from a financing perspective and what we can invest in. But there's so much more involved, and that's why Calum's here. That's what we're going to talk about. Throw all your questions in the Q&A. We were going to get to them later on, and if there's something that's specific, we will definitely make sure we send an email to Calum and get that answered. At any time, send us an email if you want a direct introduction to Mr. Calum Ross. It's info@reccanada.com. Send it to us. We'll get you introduced to Calum. Calum, you know where I want to start, my man? I want to start really high level for a second.
Okay.
Like, I know you get the question all the time, but like interest rates, what's going on? What happened during kind of COVID? Did we see a drop? What happened and what's going on?
I think the truth be told is that I think everyone who's in credit capital markets and equity capital markets is trying to figure out what the hell's going on. Is what we're actually all trying to do. They at these conference calls with all these macroeconomics people from the Schulich School, Harvard Business School, and then I'm going on these CMHC ones and all the rest of it. And apparently none of us know what's going on. Apparently, so
we're all trying to figure it out. We're all trying to figure it out. Yeah.
So here's what we do know. What we do know is that for the first time in history, the Bank of Canada went on record, and they even went as far as to have, the governor make a comment saying, if you're thinking about getting a mortgage, if you're thinking about taking a business interest loan, please understand rates are going to be low for long. Mm-hmm. And so that's the first time ever the Bank of Canada has done that. Normally, we're always waiting for their next announcement. This is like sort of the horrible rain on your parade. Next 8 Bank of Canada announcements. The answer is no change.
No change.
Okay? No change.
Great for investors.
Yeah, it is. Absolutely. I mean, when you look at, we're like at the lowest part of the operating band, and the U.S. Federal Reserve and the Bank of Canada are both of that band. And what that means is that the overnight lending rate, that impacts the short part of the curve. So the 1-year fixed rate mortgages, variable rate mortgages, but it's actually at the lowest it can be. We haven't seen all the discounts come back onto that. If you remember before this started, we saw prime less 1%. That's still not readily available. But here's the other question. I mean, people always ask, should I go fixed or variable? Mm-hmm. My answer is always, yes, you should go fixed or variable. But it's funny.
That's not a cop out. That's not a cop out.
No, it's not a cop out. Because people say, I mean, I know lots of people have timed the markets once. I don't know people have timed it twice. But here's the thing. There's got to be a payoff for it. So I'm going to put that caveat on today with, when you're talking about 5-year fixed money in the low 2% range and a variable, prime less 1%, if it got back to that, being at 1.45, I mean, this is like a bird in the hand, right? I mean, people are like, what are they gambling with? Because when I take people through the math, I'm like, look, if you've got a $400,000 mortgage and you're talking about a difference of, a quarter point, the over the course of 5 years, that's 1.25%.
Yeah.
I mean, that's interest rate risk. It's insurance against interest rate risk.
Calum, back in 2006, I bought my first home, and we got the rate was for a 5-year fixed at 4.5%. I thought I robbed the bank, dude. Like,
No.
I thought I robbed the bank at 4.5% back then. Like, now with rates at 2, like for 5-year money, we're talking in the low 2s. And if it creeps up a little bit, people freak out. Like, this is historically low. We are going to be seeing this for a while. So that's fantastic news,
Right.
But continue.
Right. So the little bit of a sort of off bet that we don't have insurance against is what's going to happen with the 5-year fixed rate, because the 5-year fixed rate is moving moves usually in accordance with the 5-year Government of Canada bond. And what we're seeing happen right now is that if there was a vaccine or something that would give a high degree of confidence in the market, we could see the yields on that rally up because the expectation of inflation and economic recovery, and therefore, that's not likely to be available the whole time once we start to get vaccines and things in order. But yeah, I mean, when you're looking at, when I first sat on CMHC's advisory committee, we looked at feasibility studies, like what would happen if 5-year rates went below 5%. And the consensus was that there'd be too much demand for housing. It would just blow up the market. Now, of course, now these people, the craziest thing, Josh, people are asking me now, I'm going to wait because it's going to go lower. I'm like, guys, okay, I want to make sure we come into really a blinding flash of the obvious here.
Right.
Okay.
Yeah.
The 5-year Government of Canada bond today trades at less than the 0.5%, which means if the floor fell out completely, your best case scenario is going to give a 0.5 point. And by the way, that means the economy is in massive turmoil. We have way bigger things to be concerned about. So if you're waiting for it to get better, the answer is you're crazy to do so. If it does move down, it will be very marginal downward movements.
Right.
Not enough to be sitting out on the sidelines.
Okay. Calum, now I want to go back high level for a sec. Okay, my man. We're talking to a lot of investors.
Yes.
And we have a lot of investors that are watching and listening right now that have 4, 5, 6, 7, 12, 14 doors.
Yes.
I want to speak to first the person that's starting out with their first property. What does Calum Ross do and advise on how to set it up so we can go get more properties down the line?
Sure. The chronology of it for most people, most people don't have an inheritance or a bunch of external investors. So for most people, what they're trying to do is buy their first property. It's probably a condo. Like my first property was a condo.
Right.
I saved when I lived in it, saved diligently. And then when I moved out of it, I could afford to keep it. And I moved into a duplex. I moved in that condo because it was cheaper to actually own than rent.
Right.
And then I moved in that duplex because it was even cheaper to live there.
Because you're renting out.
Correct.
The second apartment.
And then, as I moved out of that, fortunately able to keep. So most people tend to think of their first investment property as an investment property, when in reality is most people's first investment property is very likely a residence that they own and then they move out of.
Right.
In effect.
Right.
Right. Now, as they're building up equity in that, that's going to give them access to money that they can use to be able to then purchase a new property or otherwise. So keeping flexible mortgage terms, like for instance, avoiding the big banks on fixed rate mortgages, because we know their fees can be pretty exorbitant when they go to refinance. You could use one of the big mortgage banks for make sure you've got a home equity product behind. But, when it comes down to structuring people's personal finances, it's no different than any other financial planner would recommend. Is you've got to begin with the end in mind.
Right.
There's only 2 rules to wealth. One is you must spend less money than you make.
Yes.
That's one that most people get wrong.
Yeah.
And then, prudently manage what you have left. That's more difficult.
Right.
But, when you look at the forced savings mechanism and people get fixated on real estate doing up or down or other things, set at most basic level. If you bought a property and it paid itself off in 25 years, you got a 400% rate of return on your investment. Now, I don't know too many people who are investment advisors are sitting down straight across the face, right across the brow, and saying, look, I'm going to make you 400% worst case scenario.
Right.
But, people are going to be mindful of the fact that it does take work. It doesn't take commitment. And, it's like people like you and I, we weren't overnight successes, right?
No.
I mean,
it took me 15 years to be an overnight success.
It took me about 12 to be an overnight success. So there you go. And a pound of flesh. Yeah. So
I want to talk about refinancing.
Yes.
Okay. I'm a son of immigrants, a father who drove taxi his whole life. My mother who
I'm a first generation immigrant. I'm a legit import.
Awesome.
Yes.
I love that, brother. My mother, factory worker, and they were both taught, pay down that mortgage. Don't ever
My
refinance.
parents are Scottish. Imagine what my parents were told.
Okay, so
I tried to talk about the idea of borrowing for wealth creation with my parents. My dad spent like 4 hours awake at night, told my mom that she had to call me to say no. Very sweet
There's
though.
Something wrong with our son now.
I know, right?
It's what I get to.
Right.
Okay. But we know, like, and a lot of people that are watching right now, they understand that they have equity in their homes, and they should be refinancing. Talk a little bit about how it works. Also, I want you to touch on, out of that $2.5 billion of mortgage that you funded and money that you've helped other investors with, the successes that other investors have had by refinancing.
Well, I mean, I know that conservatively I've created an incremental $1.7 billion worth of net worth. So, I mean, that's a conservative figure. That's a pretty good number. That's more than most people need.
It's why I told you guys at the start of this marathon, we're not just bringing on any speaker. We're bringing on the top, out of the top 1%, the 1% in that as well. And that's where Calum and his team live in. Go.
Sounds so good. You said my daughter is in the background of the studio here. So I'm like, Dad's stock price just went up. Okay.
Dad's cool factor, HUD, went up a little bit, or?
So, I mean, the thing is that people understand that your entry level training with respect to real estate or mortgages, a whole bunch of these courses are not substantial. And then on top of that, it's how much business are they doing? And then what's their expertise on that? So, and when you're looking at real estate investors, it's not the face rate of interest, it's the terms that matter, right? Because, let's say hypothetically, we'll use that 2% interest rate for simplicity, and let's say 50% tax rate for simplicity.
Right.
That means your after-tax cost of borrowing is 1%.
Yep.
Now, I mean, you don't need to have, a direct line on a Wall Street, advisor, who's going to be able to crack that. I mean, you could get so many great cash flowing condos or good dividend paying stocks. And all you need to do is get an after-tax rate of return of greater than 1%. And I got to tell you, you don't have to go to some shishi business school to be getting those kind of numbers. So, if people just realize, and it's something you've said before, is that, I've certainly timed the markets on occasion correctly, but you can't consistently do that. And it's not something, it's a meaningful strategy. So when you're doing this, it's about
in the market.
It's time in the market, right? I mean, there's certainly been a number of times that I've been very wrong about corrections on real estate markets or stock markets. I've also been, somewhat right on them at points in terms of, but it's long-term appreciation. It's a great hedge against inflation. And if anything, I'd be concerned if my return numbers were too high, because that usually gets reflected out later on. And also, you got to be, it's classic Warren Buffett thing, be greedy when people are being fearful. Be fearful when people are greedy. When you see everyone making money in there, generally the ship has sailed.
Yes.
So you want to be mindful about when you hear everyone saying they're not going to do that anymore, that's when I get excited. I'm like, okay, a lot of people are saying they're not going to do this anymore. Now I start paying attention.
Well, it just happened, and it's happening as we speak at the time of this recording in the pandemic. I have way more people saying that there's no opportunities. There's no compelling buying opportunities. I don't want to invest. I won't invest. The guys and gals that I'm watching invest, they're making money. And Michael Saraceni, good mutual friend of ours, was just on before Phil, and he was talking about the 4 or 5 different ways that investors are investing and making a lot of money doing it, because we have so many that are not in those segments right now.
Correct. Well, there's a number of people who've pulled out of those segments. So
yes.
There's less people bidding on it, right? And you don't have to be a mathematician to realize if you win a tournament where there's only 5 of you, but there's still a gold medal, you still get a gold medal. I mean, it sounds way cooler to be 500 people you beat, right. But you still get a gold medal if you beat 5.
Yes.
So, you don't need to be a rocket scientist to realize the odds are stacked in your favor of you winning deals. And people need to realize too that volatile markets create market opportunities. Well, a lot of people sit on the sidelines, and it's worthwhile to sit on the sidelines and certainly observe and plan.
Mm-hmm.
But you look at there are so many types of investments around right now that because the cost of funds is so low, the dividend yields on stocks, various cash flowing real estate, that doesn't have sexy cash, but when your after tax cost of borrowing is 1%, you don't need sexy rates of return.
I agree.
Right?
I agree.
So,
now, can you just talk through about the actual process of refinancing, though?
Yeah, you
Because
bet.
I want to make sure everyone kind of catches that.
Sure. And the other thing too that I think, and this is one of the things we've talked about on various events you and I have been on before, but the very best time to borrow money is when you don't need it, because when you need money, it's very difficult to get.
So true.
So people will often say, a bank is someone who's happy to give you a mortgage. Once you prove to them you don't need it.
Yes.
Right.
Yes.
So, when it comes down to doing a refinance, the idea is that you're revisiting. First of all, you understand what your face rate of interest is. You understand what your cost to get out of it is. Whether or not it makes sense to stay with the existing lender, and a lot of times it does, because they'll be able to give you consideration on penalties or things like that. And then you need, again, an independent mortgage advisor. Whether it's with that financial institution or elsewhere. Obviously lots of my clients, I help them on mortgages that I don't arrange or otherwise. I'll just send them an email saying, hey, this is what's available. And it goes to their credit risk with my name on it. They tend to pay attention.
I like it.
So
the amount that you've done before, they're going to listen.
Yeah. I mean, again, I'm not giving people rates that don't exist but the thing is, this is going to be, if you look at from a 5-year Government of Canada bond standpoint, an overnight lending rate with the Bank of Canada. So that has the variable rate mortgages, the long-term fixed interest rates. You have the lowest interest rate period that we are very likely to ever see in our lifetime. For it to go lower, the Bank of Canada and the U.S. Federal Reserve would have to start endorsing negative interest rates, which Bank of Canada has gone on record saying they're not going to. So short of them changing their position on that, folks, this is as good as it gets.
So now, would you set it up when somebody was going to do a refinance? Would you do like a refinance, refinance the whole mortgage, or set it up as like a home equity line of credit? Yeah.
So, I mean, the idea, it depends on whether or not you're going to draw the money, right? Because you want to be keeping separate your tax deductible versus your non-tax deductible. Sorry, I forget sometimes.
It's all good, man. We're relaxing. We're in a virtual arena today. We're taking it really relaxed. It's like, look at Jazzy. Look, you make me look good. That's why I bring you on half the time, just because look at me. Look at this. Look at you, my man. Go on.
So, if you're borrowing for the purpose of investing, that money's tax deductible. So you do want to keep it separate, but you have to differentiate, because you don't want to be paying for money you don't need. And this is one of the things that's a pain point of mine. Mortgage professionals out there, you mortgage professionals who keep on refinancing people and making people pay for money they don't need.
Yeah.
You should lose your license for that.
But we'll go into that a little bit. Go into not necessarily what they're doing, but the fact that it's always, in my opinion, it's better to have that home equity line of credit, and I'll draw from it as I need it, rather than you giving me a full refinance on my mortgage, and now I'm not making use of it or I'm maybe looking into a pre-construction condo where I'm making installments, right? I'm paying it down in installments.
So a line of credit is a great short-term borrowing mechanism.
Right.
So typically, if you're going to leave it outstanding for a longer period of time, often I'll say that time period's a year, depending on what's happening with variable rate discounts, is, we have a situation where ultimately we're about saving people money and making people money, right? So it's just math, which is one of those subjects that most people don't do that well at.
Yeah.
But you want to be mindful.
Well, it's all the algebra, calculus, and all that stuff that bored me out of it. Basic math I love, and I loved it back then. It was all that other stuff that I didn't like. Continue though.
You know what? So if people spend a little bit more time, math is sexy because it makes you money.
You
start to look at it that way.
Yeah,
these are after-tax dollars.
Let's clip.
These are after-tax dollars that we're talking about, right? So when you're paying a mortgage with after-tax dollars on a principal residence, you want to be really mindful of it. The other one is the refinance is the opportunity cost. You've got this dormant equity. It's not doing anything for you than appreciating. It's paying you nothing.
Right.
You got money that's not working for you. If you ever look at a chief financial officer of a corporation or someone who runs a REIT, we're always looking at how do we deploy more capital? What's our after-tax rate of return? There are two types of real estate investors, those who have run on money and those who will run on money. So you've always got to assume you're going to have a cash flow shortage or some kind of challenge. And you always got to begin with that in mind. And it's not realistic for us, right? If we look at, you got a 50% chance of one or you or your wife becoming disabled. And people say, well, disabled. Well, disabled is a broken leg for 3 months is disabled. Doing a battle with cancer, having some other thing. There's a whole bunch of ways. So it's unrealistic for people to assume that they are not going to need money for emergency purposes and or for investing. But if you look at the people who are very savvy, they never want to be having money that's not working for them.
Well, I love what you said, because it's something that I've been saying for 15 years, if not 20 years. Get money when you don't need it, because when you need it, you'll have a tougher time. I
Right.
have a question for you, my man. Your daughter, did she need that credit card? And tell the story about the credit card that you set up. Why? Because I know there's people. I know she is.
Yes.
I know people watching and listening. I think the lesson that you're teaching her and that she's gonna learn is of massive. She's gonna get some massive results on that. Just
Yes.
tell the viewers what you're doing with the credit card with your daughter, please.
She's 16 years old, so I got her a $500 access to one of my sub accounts, but made sure that she was responsible for it, so it would show up on her credit report.
Yes.
I gave her the deal. She had to do the activation. She was calling in, and then I was showing her in real time how transactions went through and all the rest of it.
Well, I love it because she's not going to learn this in school. She's learning it now, and her just being here with us today, the amount of information she's going to get. A lot of my viewers and my nightcappers and the REC insiders know my 6-year-old just did a lemonade stand, and I walked them through revenues and expenses, because I know they're not going to learn that. Calum, my man, thank you for everybody who's watching right now and listening. Send us an email at info@reccanada.com and just put in that email. If you've already sent 42 emails for all the other stuff, send the 43rd, and later on you'll send number 78. We will be tracking them. I got a massive team in the back that's watching all these emails. Send the email info@reccanada.com and say, I need to be hooked up with Calum, that good-looking guy. I want to make sure I get hooked up with them. Send us an email and we'll make sure we get that set up. Calum, thank you. I love you.